There's a certain promise that keeps showing up everywhere you look. On YouTube, in headlines, in those eye-catching thumbnails that seem to whisper, "You can retire early, just live off dividends." And if you've spent any time exploring personal finance content, you've probably heard some version of it already. Build a portfolio, buy dividend stocks, sit back, collect income for life. It sounds effortless, almost poetic even. But here's where we need to slow down just a bit, not to dismiss the idea, but to understand it more honestly. Because dividend investing can be powerful. It can absolutely play a meaningful role in your financial life. But relying on dividends alone to fund your entire retirement? That's where the story becomes more complicated, and for most people, less realistic than it first appears. The quiet strength of dividend investing. Before we challenge the dream, let's acknowledge what dividend investing does exceptionally well, because it does bring real value to the table. There's something deeply reassuring about income that arrives consistently. Whether markets are climbing, falling, or simply drifting sideways, dividends can provide a steady stream of cash flow. And that consistency isn't just financial, it's emotional. It reduces the pressure to sell investments during downturns. It gives you breathing room. It allows you to feel, even in uncertain markets, that something is still working in your favor. That's not a small thing. For retirees especially, this can be the difference between panic and patience. When your portfolio is sending you income regularly, you're less likely to make reactive decisions. You're less tempted to abandon your plan when headlines turn negative. And then there are the companies themselves, the ones that have built reputations over decades for paying and even increasing their dividends through recessions, inflationary periods, and economic shocks. These aren't just stocks, they're businesses with long histories of discipline. Take companies like Johnson & Johnson or Procter & Gamble, often referred to as dividend kings. These firms have increased their dividends for over 50 consecutive years. That kind of consistency doesn't happen by accident. It reflects durable business models, strong cash flows, and a commitment to shareholders. And for someone building a retirement income strategy, that reliability can feel like a solid foundation. The part no one likes to talk about. But here's the truth that tends to get glossed over in those viral videos. To live entirely off dividends, you need a very large portfolio. Let's walk through a simple, realistic example. If your goal is to generate $100,000 per year in dividend income, and you're targeting a yield of about 3%, which is generally considered sustainable, you would need a portfolio of over $3 million. That's not a typo, $3 million. Now pause for a moment and sit with that number. Not to discourage yourself, but to ground the conversation in reality. For many people, especially those starting later or earning average incomes, reaching that level of savings is extremely challenging. And even for those who do get there, maintaining that income without ever touching the principal isn't always practical. Because life doesn't stay static. Expenses change, healthcare costs rise, unexpected events happen. And the idea that you'll never need to draw down your savings at all, that's more of a fantasy than a plan. The trade-off you can't avoid. There's another layer to this that often gets overlooked. The companies that offer the most reliable dividends are usually not the ones delivering explosive growth. They tend to be mature businesses, steady, predictable, but slower moving. On the other hand, high-growth companies, think of names like Nvidia, often pay little to no dividends at all. Instead, they reinvest their earnings back into the business to fuel expansion. So you're constantly navigating a trade-off, stability and income, or growth and potential appreciation. And rarely do you get both in equal measure. If you focus too heavily on dividends, you might miss out on the kind of growth that helps your portfolio keep up with inflation over time. But if you chase growth exclusively, you may find yourself without the income stream you need when you actually retire. This tension isn't something to solve, it's something to manage thoughtfully. The danger of chasing yield. Now let's talk about one of the biggest traps in dividend investing, because it's incredibly tempting: high yields. You might come across a stock offering a 10%, 15%, even 20+% dividend yield. On the surface, it looks like a dream. Why settle for 3% when you can earn so much more? But this is where experience and a bit of skepticism really matter, because unusually high yields are often a signal that something isn't quite right. Take a company like Advanced Flower Capital, which has offered extremely high yields. On paper, it looks impressive, but when you dig deeper, you find exposure to a volatile industry, uncertain loan repayments, and business risks that could threaten those payouts. In many cases, a high yield isn't a gift, it's a warning. It may reflect declining stock prices, unstable earnings, or a business model under pressure. And when dividends get cut, and they do get cut, the impact can be painful, especially if you were relying on that income. A more sustainable approach is to focus on a moderate yield, typically in the 3 to 5% range. That's where you're more likely to find balance, income that's meaningful but also maintainable. Because your income stream shouldn't feel like a gamble, it should feel dependable. A more balanced way forward. So if living entirely off dividends isn't realistic for most people, what is? The answer isn't abandoning dividends, it's integrating them into a broader, more flexible strategy. Think of your portfolio not as a single tool, but as a system. At its core, you might include dividend-paying ETFs, diversified low-cost vehicles that provide income without relying on individual stock picks. Layer in high-quality dividend stocks for stability. Add growth-oriented investments to help your portfolio expand over time and keep pace with inflation. And then, this part often gets overlooked, include cash or short-term bonds to cover near-term expenses. This creates a kind of structure, a hierarchy. You can even visualize it as a pyramid. At the base, dependable income sources. In the middle, balanced growth investments. Near the top, higher growth opportunities. And at the very top, liquidity for short-term needs. Each layer serves a purpose, and together they create resilience. The role of flexibility. Perhaps the most important element of any retirement strategy isn't a specific asset or yield target, it's flexibility. Because no matter how carefully you plan, things will change. Dividends can be reduced, markets can shift, tax laws can evolve. Your own needs and priorities will almost certainly look different over time. A rigid plan, one that depends entirely on a single income source, is far more vulnerable than a flexible one. Sometimes that flexibility means adjusting your spending. Other times, it means drawing from your principal. And yes, that can feel uncomfortable. But it's not a failure. It's part of how a well-designed retirement strategy actually works. You didn't save that money just to admire it. You saved it to use it, bringing it all together. So, can you live off dividends? Maybe. For a small group of people with very large portfolios and relatively modest spending needs, it's possible. But for most people, the smarter, more sustainable path is a diversified approach, one that blends income, growth, and liquidity, one that adapts as life unfolds. Because real financial security isn't about chasing a single strategy to its extreme. It's about building something balanced, something resilient, something that works not just in theory, but in real life. And perhaps that's the most important shift of all. Moving away from the idea of set it and forget it, toward a mindset of thoughtful, ongoing stewardship. Because your portfolio isn't just a collection of investments. It's a reflection of your life, your goals, and your future. When theory meets real life. On paper, the idea of living off dividends feels clean and controlled. You build a portfolio, generate income, and never touch your principal. But real life rarely follows clean lines. Think about the early years of retirement. This is often when people spend the most, traveling, helping family, finally doing the things they've postponed for decades. Then later, expenses might shift toward healthcare, long-term care, or simply adapting to new needs. Your financial life moves in phases, and if your entire strategy is built on a fixed stream of dividend income, you may find yourself constrained, either forced to cut back when you don't want to, or stretched thin when unexpected costs arise. That's why a more dynamic approach matters, because retirement isn't just about replacing income, it's about supporting a life that continues to evolve. The inflation problem most people underestimate. There's another quiet risk in relying too heavily on dividends, and it's one that doesn't show up immediately: inflation. At first, it feels manageable. Prices creep up slowly. Maybe your dividend income increases a little each year as companies raise their payouts. But over time, inflation compounds in a way that can quietly erode your purchasing power. What costs $100 today might cost $150 or more in the future. And if your income isn't keeping pace, you're effectively earning less, even if the dollar amount stays the same. This is where growth investments play a crucial role. They're not there to replace income. They're there to protect your future income. Companies like Nvidia, for example, may not offer meaningful dividends today, but their growth potential can help your portfolio expand over time. That growth can later be converted into income when needed. It's a longer game, but an essential one, because without growth, even the most stable income strategy can slowly lose ground. Why total return matters more than you think. One of the biggest mindset shifts, especially for dividend-focused investors, is moving from an income-only perspective to a total return perspective. This idea is central to how thoughtful investors, including voices like Christine Benz, approach retirement planning. Total return simply means looking at the full picture: income, dividends, interest, plus growth, price appreciation. Because ultimately, what matters isn't just how much income your portfolio produces, it's how well it sustains you over time. Sometimes that means selling a small portion of your investments, and that's where many people hesitate. There's this emotional barrier, this feeling that selling shares is somehow losing money, while dividends feel like free income. But in reality, both come from the same source: your portfolio. Whether a company pays you a dividend or you sell a small number of shares, the outcome is similar. You're converting part of your investment into cash to support your life. Understanding this can be incredibly freeing because it opens up more options. It gives you flexibility, and it allows you to design a strategy that works with reality, not against it. The emotional side of investing that no one talks about enough. Let's be honest for a moment. Investing isn't just math, it's emotional. And dividend investing in particular has a strong emotional appeal. There's comfort in seeing cash hit your account regularly. It feels tangible, reliable, almost like a paycheck. That feeling matters. But it can also create blind spots. It can lead you to prioritize income over overall portfolio health, to ignore warning signs in high-yield investments, to hold on to positions longer than you should simply because they're paying you. And this is where balance becomes essential, not just financially, but psychologically. A well-structured portfolio should not only perform well, it should also help you stay disciplined. Because the biggest risk to any plan isn't market volatility. It's making decisions in moments of fear, anxiety, or overconfidence. Rebalancing, the quiet discipline that keeps you on track. One of the most overlooked aspects of long-term investing is rebalancing. It's not flashy, it doesn't make headlines, but it's incredibly important. Over time, different parts of your portfolio will grow at different rates. Your growth stocks might surge. Your dividend payers might remain steady. Your bonds might lag or stabilize depending on the environment. And without intervention, your carefully designed allocation can drift. Rebalancing is simply the act of bringing things back into alignment. It might mean trimming positions that have grown too large, or adding to areas that have fallen behind. It's a way of quietly managing risk. And more importantly, it reinforces discipline. Buying low, selling high, and staying anchored to your long-term strategy rather than reacting to short-term noise. What a thoughtful retirement portfolio really looks like. If we step back and look at everything we've discussed, a clearer picture begins to emerge. A strong retirement portfolio isn't built on a single idea, even a good one like dividends. It's built on layers. You might start with a foundation of high-quality dividend payers, companies like Johnson & Johnson or Procter & Gamble, that provide stability and income. Then you add diversified funds or ETFs to broaden your exposure and reduce individual risk. You include growth-oriented investments to ensure your portfolio continues to expand over time. And you maintain a portion in cash or short-term instruments to cover near-term needs, so you're not forced to sell during unfavorable market conditions. Each piece serves a role, and together they create something far more powerful than any single strategy alone. A more honest answer to the big question. So let's come back to the question that started all of this. Can you live off dividends? The honest answer isn't a simple yes or no. It depends. It depends on your portfolio size, your spending needs, your flexibility, your willingness to adapt. For a small group of people with significant assets and relatively modest lifestyles, it may be entirely possible. But for most people, the better question isn't, can I live off dividends alone? It's, how can I build a portfolio that supports my life, reliably, sustainably, and with flexibility? And when you ask that question, the answer almost always leads you back to diversification. There's a subtle but important shift that happens when you move away from chasing a single, perfect strategy. You start thinking less about optimization and more about resilience. Because the goal isn't to build a portfolio that works perfectly under ideal conditions. It's to build one that holds up, even when things aren't ideal. Markets will change. Your life will change. The world will change in ways none of us can fully predict. And the investors who navigate that successfully aren't the ones who bet everything on one idea. They're the ones who build thoughtfully, who stay flexible, who adjust when needed. So yes, dividends can absolutely be part of your story. They can provide income, stability, and peace of mind. But they work best not as the entire plan, but as one piece of a broader, more balanced approach. If you're looking to take this further, if you want to build a portfolio that actually supports your long-term goals, not just an idealized version of them, then it's worth continuing to learn, refine, and stay engaged. Because this isn't something you set once and forget. It's something you grow into. And that's where real financial confidence comes from. Not from chasing the simplest answer, but from understanding the full picture and building something that truly fits your life.